And now on I go to Wolf Richter's site, Wolf Street, because there's an interesting article here about the retail, I like to call apocalypse. He likes to call it on this point, the retail meltdown. Brick and mortar retail meltdown fueled by asset stripping. Asset stripping? I'm like, what? This ought to be interesting. What does he mean by that? Asset stripping. Details emerge in bankruptcy courts. Price to earnings firms win again, or PE firms win again. Stiff creditors not amused in bankruptcy court. Near every retail chain caught up in the brick and mortar meltdown is an LBO queen, acquired in a leveraged buyout by a private equity firm either during the LBO boom, before the financial crisis, or in the years of ultra cheap money following it. During a leveraged buyout, the PE firm uses little of its own capital. Much of the money needed to buy the retailer comes from debt the retailer itself has to issue to fund the buyout, which leaves the retailer highly leveraged. The PE firm then makes the retailer issue even more junk bonds or leveraged loans to fund a special dividend back to the PE firm. Come hell or high water, the PE firm has extracted its money. Then the PE firm charges the retailer hefty management fees on an ongoing basis. This form of asset stripping removes cash from the retailer and leaves it struggling under a load of debt. It works wonderfully until it doesn't. Remember how Zero Hedge had that article? It does, or it works fine, until it doesn't. Pensions are okay and well-funded until they're not. Your 401k is doing great until it's not. How's that flying around over there? Got my little lights, my little, studio lights, if you will. Which, if you're wondering, let me give you a little peek at what these things look like. And then I've got this one over here, facing the green screen behind me, which you can see keyed out on the wall. But I'm hearing like this little tick, tick, tick. What the hell is that? And I see a bug going ape to get to that light right now. It's like pounding head first into the light. It must have just smashed itself or something. Must have smashed itself to death. Either that or it just found out its bug 401k just got crushed and it's upset and committing suicide. One or the other. This form of asset stripping removes cash from the retailer and leaves it struggling under a load of debt. It works wonderfully until it doesn't, until booming online sales started eating their lunch, sending these over-leveraged retailers, one after the other, into bankruptcy court, where creditors learn what it means to end up holding the bag. But they're not amused, as we now see. But first, the numbers. Since 2010, retail chains owned by PE firms have issued, I don't know if you're thinking PE price earnings. PE, what is PE? I thought like mergers and acquisitions for like whatever. PE is what we're going for. Since 2010, retail chains owned by PE firms have issued $91 billion that's dollars of course, in junk bonds and leveraged loans just to raise the money for the special dividends paid to their PE owners, according to data by LCD and S&P Global Market Intelligence, cited by the Wall Street Journal. This does not include debt piled on retailers during the LBO itself, and it does not include drugstores and food retailers, such as PE firm-owned Safeway Albertsons, caught up in the middle of the meltdown. The chart shows, which I'll go ahead and pump. I'll pump you up. I'll pump it up on the screen. The chart shows how the asset stripping business boomed until 2015, when the brick and mortar meltdown set in. 2017 issuance through June. Not look at 2015, 2016, 2017. Not. Repeat. Not looking good. This is why I come out here talking about the retail apocalypse. Whatever. The numbers don't lie. The PE firms get the cash. The retailer gets the debt. By the time the retailer goes bankrupt, the PE firm has already gotten their money out. Creditors, usually institutional investors plowing in other people's money, are left fighting over scraps. Payless Incorporated, the shoe retailer, with 22,000 employees and 4,000 stores in 30 countries, filed for Chapter 11 bankruptcy on April 4th. In the filing, it said it plans to cut its debt in half, stiffing creditors for the rest. In 2012, Payless was acquired in a leveraged buyout by PE firms Golden Gate Capital and Bloom Capital Partners less than 5 years ago from LBO to bankruptcy. Over those 5 years, Payless piled on more than $700 million in debt, that is new debt. This includes the debt resulting from the LBO plus the debt to fund $350 million in special dividends to the PE firms. They also extracted management fees. In bankruptcy court, Payless revealed that in 2016, it had about $2.3 billion in revenues and $840 million in debt. In addition, as it is shuttering hundreds of stores, its off-balance sheet obligations, store leases, etc., have come to the surface, and landlords are clamoring for their money. Vendors fear they're getting shafted, and they all blame the special dividends and management fees extracted by the PE firms. The Journal says, vendors and landlords alleged in court papers that the dividend payouts, along with other payments to the investors, left the retailer particularly vulnerable to collapse, just as technology and shifting consumer behavior upended the retail industry. Quote, the depletion of their coffers put the company on a dangerous path that ultimately led to this instant bankruptcy filing, a group of Payless unsecured creditors said in June court papers. Lenders that are owed the majority of the debt will end up controlling the melted down retailer, and they got a tiny consolidation price for their screaming in bankruptcy court. And according to the Journal, following heated exchanges and filings and in the courtroom, as well as private negotiations, the private equity backers and lenders have agreed to give more than $20 million to the company, which will be used toward beefing up the creditors' recoveries. Meanwhile, the creditors have agreed to not bring any legal claims against the backers following the bankruptcy filing. And then there's Jamboree Corp., the operator of 1,281 children's clothing stores and 11,000 employees, and I think he meant 11,000 employed, filed for Chapter 11 bankruptcy on June 11th after defaulting on an interest payment. The leveraged buyout by Bain Capital in 2010 piled $1.8 billion in debt on the company. Bain also extracted management fees over the years. The restructuring plan calls for stiffing creditors out of about $1 billion, and some of the creditors were having a cow. Earlier this month, Jamboree's unsecured creditors, including vendors and landlords, owed an estimated $220 million, said in court papers that they have been investigating potential claims against Bain and other insiders. The creditors, which are slated to receive nothing, point to dividends and fees received by Bain and its affiliates. And denim designer and retailer True Religion. Losing my religion, trying to keep up out of bankruptcy, but I don't know if I can do it. Oh no, we've paid too much. The dividends were too much. I thought that I heard you laughing in court. Sorry about that. And denim designer and retailer True Religion, with 1,900 employees, filed for Chapter 11 bankruptcy on July 5th. PE firm Towerbrook Capital Partners had acquired the company for $835 million in 2013. The company is now saddled with $535 million in debt. It only had $370 million in revenue in 2016, by the way. 4 years from LBO to bankruptcy. In the prepackaged bankruptcy, Towerbrooks worked out a deal with senior lenders, including a debt for equity swap that will wipe out $350 million of its debt. These lenders will get 90% of the equity in the restructured company, but junior creditors are not amused. Again, according to the Journal, a junior debt lender, Ares Management LP, raised concerns about the proposed restructuring plan, which will leave the creditor with a slim recovery, while private equity backer Towerbrook Capital Partners LP is slated to receive the same or higher return as Ares. Typically in bankruptcy, lenders expect to be paid before equity owners. During the first day hearing, an attorney for Ares said the firm didn't support the plan, and an investigation may be needed to better understand Towerbrook's role. Can you guys see why I like dealing with my own type of investment stuff? Could you imagine being some kind of bondholder to that junk bond of these companies, or some kind of shareholder getting absolutely crushed to death on your investment? Can you see why I like to hold precious metals physically, and I like to play the crypto game as pure speculation? And as you know, these things are doing great across the board. Now, granted, we understand there's a few that are just sitting there idle. Some are a little bit down, whatever. I get it. But have you ever seen the entire stock market go up at the same time? Does every company's stock go up at the same time? No. And crypto shouldn't be expected to be either. However, many of them do. So if you spread your love, so to speak, you know, your portfolio, you should do fine in that space. And if you're not doing good right now, just hold and wait. Just wait. A lot of times these PE firms acquire part of the bonds before bankruptcy of their portfolio company for cents on the dollar. For example, Bain Capital bought significant amounts of Gymboree bonds. This gave PE firms more control during the bankruptcy proceedings. And they win again. They're going to take control so much, they're going to win. You're going to get tired of these PE firms destroying companies. They're going to win so much. You're going to get tired of them here. We're going to win. Oh, wait, but that was Donald Trump. That was Donald Trump saying, you guys can't steal that. Why do institutional investors fund asset stripping associated with LBOs and special dividends? Some of the answers are in Wall Street's culture, where fee extraction is everything, and one firm helps another. And two, they're chasing yield in a world where central banks have repressed yield, which turns out to be a costly chase, yield being interest rates. Retail landlords are reading the memo, but it may be too late. Read, will plunging store rents slow the retail doom and gloom? Which he links to, and I will, of course, be linking to this video. Yeah. I just, like I said a few times, I kind of wait for the day here. Is there going to be a day? I'm going to have to ask the Magic 8 Ball this one. I'll just go ahead and ask it now. Magic 8 Ball, is there ever going to be a day in the foreseeable future of me doing videos, which should be years and years and years continuing, that I'm going to come out here and say, guys, I've got some good news. We were definitely in recovery mode. Things are picking up again. Wages are back up. You know, Magic 8 Ball, is this going to happen in the foreseeable future? Ask again later. Ask again later. Magic 8 Ball, I've been pretty kind to you when you give me answers like that lately, and I just put you back down. 1, 2, 3. It's later. Magic 8 Ball, answer the question now. Outlook is good. Thanks, Magic 8 Ball. I think Magic 8 Ball just did the adult to child thing to me. You know, Dad, can I go spend the night? I don't want to say no. They're going to hound me all night. Maybe. Maybe? Okay. That'll hold them off till later, till I have to tell them no. Magic 8 Ball tells me, ask me later. Kind of the same thing. Okay. I'm at Magic 8 Ball. It's later. Can I answer now? Yeah, oh yeah, it's fine. Magic 8 Ball. In all seriousness, I can't wait for the day where I can come out here and bring you great news. Hey, jobs are back up and this is happening. Of course, you're probably saying now, but Joe, aren't 4.3%, 4.4% unemployment? Jobs should be great. Yeah, if you believe that horse manure, 4.3 unemployment, get the hell out of here. Really trying to kid. Everybody's on freaking EBT. Maybe they're counting the people on EBT as employed. Well, they earn money, don't they? Yes, then they're employed. Mark it down. Take care.